Hello, everyone. Today on the Final Bar, I'm joined by Alex Cole from GoNoGo Charts. We'll talk about this market continuing to bounce to the upside. The S&P testing 4550, that key level of support and resistance that we reviewed a number of times on the show. Today, driven by energy, you have stocks like Exxon, Chevron, others pushing to the upside. Is this a further move to continue this recovery, or the last bounce before the next leg lower? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a kind of snowy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the language of technical analysis, using the technical toolkit to better quantify investor behavior, looking at signals based on trend, momentum, breadth, sentiment, all of that good stuff to try to make sense of these markets in uncertain times. I think the main question for a lot of investors, whether or not you're a short-term investor, whether you're a long-term investor, is trying to understand this sort of bounce phase we're in, right? If that's what we call it. We had the big distribution, November, December, really accelerating it to January with a pretty painful month. There's this thing called the January barometer, the January effect, a number of ways to describe the phenomenon of whatever happens in January and extending that. So if a weak January sort of is a foreboding sign of a weaker year, I would tell you probably the data on that, the stats are fairly mixed. I don't know if I'd feel as good about that as I'd probably feel about the Super Bowl indicator. Maybe interesting, but I don't know if I would really bet my a fund on that sort of behavior. However, it certainly indicates the weakness that we've seen in the new year. But so far, February is starting off with a continued bounce to the upside, and now the S&P testing 4550, which is one of those key levels we've been talking about. So what happens now as we face that clear level of resistance? We have great guests on the show. I'm excited to talk to the guys at GoNoGo Charts today. Alex Cole is going to be on the show here shortly. Coming up next week, we have, tomorrow, we have Julius DeKempener, Wednesday, the 2nd, from RRG Research. On Thursday this week, we have Frank Capillari from Instanet, one of the greats, does a really good job, a big institutional following, and can share some ideas with us. Next week, on the 8th, we have Sam Burns from Mill Street Research coming to us from the Boston area. Couple other quick announcements for you just to wrap up our upcoming schedule. I'll be speaking at the Money Show next week. It's actually a cannabis-oriented show. I'll be talking about applying momentum techniques to cannabis stocks, and I'll be doing it with Greg Schnell from GregSchnell.com. He's obviously up in the Calgary area, up in Canada, with a big focus on cannabis and a lot of investors up there. So we'll compare our notes and talk about some momentum plays, particularly in that space. You can go to StockCharts.com/moneyshow actually to sign up for that event. Let's continue on with our market recap. Today, our market recap is brought to you by Trade Your Brokerage on StockCharts ACP. You can actually trade individual stocks and ETFs. Click on the little Trade Your link in the bottom right corner of our ACP platform. As we go through our market recap here, we're seeing the S&P get right back up to 4550. Not exactly there, but really, really close. And a lot of that move came in the last hour of the day. So for what it's worth, yesterday, big move up to the upside in the last 30 minutes. Today, a big move higher in the last hour. It was sort of a flat day about an hour ago, and then really moving to the upside to finish a little in a position of strength here. The S&P closing up 0.7%, the NASDAQ outperforming just slightly, mid caps and small caps up as well. And the mid cap index was actually the best performer of the three, up 1%. The VIX was above 30, I feel like a couple days ago, and now all of a sudden down near 20 again. It's down to 22, so it's come down from over 30 to low 20s just in a couple days. Shows you that change in momentum very, very quickly in the equity markets this week. 10-year yields pushing higher, actually chopped around for a bit, but settled in right around 1.8%. We've talked about that concept of higher interest rates. And I was talking with Julius DeKempener coming on the show tomorrow. We're actually going to be speaking at the Money Show next month, the virtual expo, and we'll be talking about higher rates and what that means for growth versus value, small versus large, and some of those other relationships, and how you can see the rotation around the S&P. But I think that higher rate thesis is something to embrace and get familiar with. And I would look at periods of time in market history where you've seen a rising rate environment. Be prepared for what that might look like. It's a different look than we've had, I think, for a lot of equity investors for quite some time. The dollar index rotating lower around 0.25%. And we've talked a lot about that recently, sort of had that weaker dollar coming out of the of year end, but all of a sudden rotating back to the upside. The dollar index making a new swing high in the last week or so. Stronger dollar usually means stronger U.S. stocks, usually means weaker gold, and that's certainly something to pay attention to. If we get further weakness in the dollar, that's when you could start to expect gold to emerge higher. Today, we'll look at some of the other asset classes. We looked at equities, bonds. We look at gold flat for the day with the GLD pretty much where it was yesterday. Silver up about 0.2%, not too much movement. Energy stocks, the big winner today. Even oil prices were relatively flat. It's a big earnings-driven move overall. Cryptocurrencies overall more stronger than weaker, with Ether sort of leading the way higher. Some of the major coins up over 3%. Bitcoin a little different, sort of flat. And it's a good reminder when you look at charts of Bitcoin and Ether and Litecoin and some of these other ones. It's very easy to think of all cryptos as one thing, just like you think of maybe commodities as one thing. And while you can aggregate them, remember these are actually very different with some potential to differentiate one another. And we've seen that with the ratio of Ether to Bitcoin. We don't have time to look at it today, but certainly encourage you to take a look at it. When we talk about the S&P 500, I have these three sort of shaded areas. These are levels we've been talking about for a couple of months now and highlighting them. On the top, we have 4,700, and I see that late December move is sort of a failed attempt to eclipse resistance and came back down and now obviously well below 4,700. We saw sort of a similar move down here on the lower end with 4,300, the lows from September and October. We traded below it, never really got a close below 4,300. Now we're literally kind of right in the middle, right? We're right back to 4,550, which has served as resistance and support a number of times over the last couple months. On my YouTube channel called Market Misbehavior, I recently posted a video talking about what's called polarity, which is where levels of resistance become support and vice versa. So if you didn't understand what I just described on there, I would certainly take a look at that video. It could help to clarify that perspective a little bit. I'm noticing on every time the S&P has attempted to make a new high, for the most part, we've seen lower peaks in momentum. And that's sort of an interesting side observation to pay attention to. Can we get a stronger momentum picture? Can the RSI eclipse 60? That would tell me that there's enough buying power overwhelming the selling pressure. And that could indicate the higher potential for further upside. Still a lot to be proven, even though it is quite an impressive bounce from 42.20, 42.30, all the way up to 45.50 in just about a week and a half. Let's look elsewhere here to round off our market recap. I mentioned it was sort of energy and everything else today, although other sectors like materials and industrials did fine, financials as well. So very much a cyclical feel, a value-oriented feel to the tape today. Things like technology lagging behind the S&P overall. This is driven by some of the value-oriented spaces. And I'm thinking of charts like Exxon, just reported before the open today, up over 6% today. A lot of big earnings this week. I mean, we don't have time to go through all of them on the show, but you have Exxon today, you have ConocoPhillips on Thursday. Chevron was just last week. And if you look at some of these major integrated names, it's interesting when you look at the chart of CVX, would you guess that there's been sort of a significant pullback in the last month? Probably not. I'm always interested when the market is doing one thing, but a particular chart looks dramatically different. And that's the sort of the picture that you'll see with a lot of these energy names right now. They're sort of showing that there's no real concern going on here. Now, a number of these are overbought recently, and that's certainly something to pay attention to. Overbought on its own does not mean a bad thing. It just basically, I always say overbought means up a lot. It means the price has elevated quite a bit recently. It doesn't necessarily mean that the uptrend is over. It just tells you might be looking for some opportunities for maybe a tactical pullback, which is something we've seen on a lot of charts when you have that big sort of push higher and prices get very elevated very quickly. Elsewhere, as I mentioned, materials doing well, industrials, financials. What happened on the bottom of the list? It's very defensive stuff: utilities, real estate, consumer staples. So if you're trying to draw a generalized conclusion from today, what I would say based on the leadership and the laggardship, this was definitely offense over defense and value over growth is sort of the general way that I would describe the feel of this. One of the sort of broad market indicators we've talked about before is the relative strength of utilities. When utilities are doing well, that usually is not a great sign for the market. And the reason is because they're not sexy. They're certainly not offense. And if the market's doing well, you're probably not going to get paid very well to own utilities. Although there have been times in market history where utilities and even REITs have led in a bull market phase. So don't use that as a general assumption. However, people usually only own utilities and REITs if they want to get defensive, and they're betting on the income component of it, and they're trying to ride out some periods of market uncertainty. The fact that utilities are lagging, the fact that REITs are lagging, I would definitely put that a check in the bullish column. Those sectors not doing as well on a relative basis, in particular, it tells you that investors are stepping more on the accelerator and getting more bullishly positioned than they might have previously. Just one last chart I'll show you today, the ratio, thinking of offense versus defense, of looking at consumer discretionary versus consumer staples. That's this chart here. When we talk about how the market conditions changed in November, this is one of the charts that comes to mind. You have this rollover in the ratio where staples are outperforming discretionary on an equal weighted basis along with a cap weighted basis. That little bounce today you've seen, or this week, is just this little blip here. Overall, I would argue the larger trend is still down until proven otherwise. Let's see if offense starts to dominate defense. That would tell you, give you some sort of potential all clear signal. We need to take a quick commercial break. We'll be back with Alex Cole from GoNoGo Charts. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market environment using the power of stock charts, using data visualization techniques to better quantify investor behavior. A couple of comments before we get to today's guest, Alex Cole. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We'd love to answer your question live on the air. You can get your questions to us via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours in our next mailbag segment, Friday of this week. Also, go to StockChartsTV.com. That is our on-demand platform. Great special events like The Pitch, like our Market Outlook specials from January featuring Larry Williams, Martin Pring, many, many others. Special guest appearances like Alex Cole and many others sharing their expertise. You could go to StockChartsTV.com, set up a free account with your email address, or on your mobile device, just go to any of the app stores and search for StockCharts TV on demand. I want to welcome on today's guest, Alex Cole. Alex is the CEO, co-founder of GoNoGo Charts, coming to us from the New York area. Alex, welcome to the show. It's good to have you on.
Thank you, Dave. It's a pleasure to be with you.
I've known you for quite a while, and I'm super excited that a Stock Charts community is learning more about the GoNoGo methodology that you've designed. We're starting with the chart of the S&P 500. What are you seeing right now in this environment?
Yeah, and a lot of the things that you mentioned really jump out at me. A lot of the things we look at very in the same way. And the first thing you talked about was polarity, and you can see I've got sort of a similar range of resistance drawn on here. Right around that. I think today we traded, like you said, up about 0.7%, but we're still what I consider in that area of resistance. And the GoNoGo charts were developed to try to blend all of the foundational concepts and the things that I've used over the years into one color-coded indicator that would give us a sense of that trend. You also just mentioned that you thought that we were still looking at a downtrend in terms of the offense versus defense. And I would argue that the weight of the evidence suggests, even here with the bounce we've had this week, that we're still in a no-go trend. And you can see here that yesterday's bar and today's as well are pink. So the trend is weakened, the no-go trend is weakened, but we're still seeing that the weight of the evidence is to the downside. And what I like to look at, which is in the bottom panel, is a similar blended indicator that tells us about the momentum analysis. You were talking about momentum a lot as well earlier on the show. And what we tried to do with the GoNoGo oscillator is create something that would give us an objective level that is support and resistance when in trend. So yeah, we can see the falling highs in momentum that you talked about as we've made higher price highs. That gives us traditional divergence. But right now, it's very, very interesting moment because the oscillator is touching up against that zero line and has actually spent a couple of bars there now, which tells us that all of the inputs to the momentum oscillator are in their neutral territory. So it's like an RSI being between 30 and 70. Now, if this no-go trend is to hold, we certainly wouldn't expect overbought readings, right? Because in a no-go, we're going to go oversold. We're going to come back to neutral. We're going to go oversold. So for us, we're going to look very carefully now at this zero line to see if that holds as resistance. And especially with that level lining up with what we see in the price chart in terms of traditional resistance, we're going to be very, very cagey until we can break back into positive territory. If it gets turned away and we see momentum go back to negative territory, then we'd expect perhaps price to move back lower into the range that it's sort of been in between 4,300, like you were mentioning, and up to 4,550. And unless we get that positive momentum, we're going to wait and see if we can get back up to the highs that we saw earlier in the chart.
It's a great take, and I appreciate you talking through this, Alex, because it strikes me that this rebound we've seen up until resistance looks a lot like the beginning of what a recovery could look like, but it also looks a lot like some bear market rallies that you and I have probably seen over our careers. So I'm still sort of tentative, and I think your chart sort of tells that story very well. Now, certain things are starting to emerge in positions of strength. You're highlighting the DBA, which is an agriculture ETF. Talk through this one for us. Yeah.
So again, I mean, we're all talking about many of the same things just jumping out of our charts, right? So the idea of the rotation into cyclical sectors. We've heard people talking about the possibilities of a commodity super cycle. This is a very long-term chart. This is a monthly chart of the DBA, which is a diversified agriculture fund, like you said. And we have seen that rotation into value away from growth into these cyclical sectors like materials and industrials and energy. Like energy, if you've had your money in energy for the last few weeks, you've been stripping the markets by some margin. And so this is a very, very long-term chart, but it is significant how we really have seen the trend change taking shape. And the oscillator, we mentioned a little bit how it works, but throughout most of this downtrend in this commodity fund, the oscillator stays below the zero line and gets turned away. We saw, towards the middle and the end of 2021, that inability to find resistance there, and the oscillator breaks above zero. And on heavy volume, we know that because the oscillator is darker. It's a darker blue color. So on the very, very large picture, we're seeing a real shift to a bullish situation, a go trend that is strengthening to bright blue bars with momentum in positive territory.
It's fantastic, and I appreciate you bringing. I'm always thankful when a guest brings a long-term chart to remind us to get away from sort of the noise of the daily markets. I think we're seeing a lot of that noise right now. We only have about 30 seconds left, Alex, but if I could ask you a random question. This week we're faced with a lot of earnings from some of the biggest, the FANG names, right? The mega cap stocks, things like Alphabet today, Amazon and others, Facebook. Based on your methodology, if you look at something like, we should start calling it Meta here at some point, what would you need to see on a chart like a Meta to start to look constructive? I would imagine, based on your methodology, it's probably still leaning negative just because of the downtrend, but how would you look at it going into earnings this week?
Yeah, I mean, you're absolutely right. A lot of those growth names look similar to the S&P chart. The S&P being on a market cap basis, you could argue dominated by some of those massive tech firms. And if you look at the NASDAQ, even more so. So we're seeing that trend in a no-go still, but like you said, a bear market rally or a start of a new trend, often technology can lead, especially what we've seen over the last few years. But we are seeing it in a weaker no-go, just like the S&P. It's those pink bars, not the purple. But we're going to be looking as well at, it's remarkable, but the zero line is being tested again from below on something like Facebook. So we need to see some positive momentum. If we do see the oscillator cross into positive territory, then we may see price move higher and set a new swing high. But until that happens, on a sort of medium-term perspective, on a daily chart, I'm still saying the weight of the evidence might be slightly to the no-go.
We'll have to wait for the price to prove itself, right? Alex, listen, right. It's awesome to have you on the show. Really appreciate you talking through some of this. Stay safe, be well. Best to Tyler Wood, and we'll talk to you again soon.
You too, sir.
That's Alex Cole. Alex is CEO and co-founder of GoNoGo Charts. And if you caught the methodology, I loved how he described with the chart of the S&P and then looking at the DVA, the agriculture fund, how that aggregates all of a number of different indicators into one set of tools. And I think there's a beautiful simplicity to the GoNoGo methodology. By the way, they have a plugin on our ACP platform. So on ACP, go to the bottom right, you'll see the little plug and you'll see more information about the GoNoGo Charts plugin as a premium add-on to ACP. Great take there from Alex Cole. Let's continue on today's show with our mailbag. As a reminder, we love to hear from you. We love to get your questions on anything market related, technical analysis related, particular indicators, charts that you're looking at. We're here to help address your questions, and our email is thefinalbar@stockcharts.com. Let's get to it. Question number one. When stock picking and looking at correlation, is it better to use an ETF or the appropriate S&P 500 group? I'm looking at DVN. Should I use XLE or $GSPEN? Yeah, so what you're asking, I believe, is if I'm looking at Devon Energy, DVN, you'll see at the bottom, I'm usually looking at the relative performance or correlation. I would probably group these in the same way. If you're looking at correlation in particular, I don't know if it's going to make a ton of difference, to be honest with you. I remember when I was early on in my career and ETFs were still kind of a newer thing, and we were sort of like trying to figure out that, and there certainly weren't as many, and definitely no active ETFs to pay attention to. It was more the idea that you could quantify, and what we loved about them as technical analysts was all of a sudden you had great tradable data, supply and demand illustrations using the data on ETFs. You could see where funds were flowing and you look at the price behavior. So at that point, I got very comfortable with using ETFs. And so I would use DVN and I would use it versus the XLE or anything. If you do $GSPEN, those are the indexes. Those are actually the energy group indexes. So we have all the S&P indexes tickerized on the platform. To be honest with you, I would probably not really care too much which one of those I use. I would be amazed if you had dramatically different values from those. I tend to use the ETFs if at all possible, only because I feel like it's a good source of data and it's fairly consistent. Index data I found on different platforms can be kind of squirrely because there's no real standard ways to measure a lot of things, unfortunately, and no benchmarks we're all hitting. ETF data is market data, and we can all agree on where an ETF traded at a particular time. So I would probably opt for an ETF if you have the ability to do so. Some of those groups, by the way, if you're looking at like airlines, and there's like the Jets ETF, but it's not as liquid, I could see using like an industry group index because it's the best source of data that you have. Next question, interested in knowing what you saw pertaining to market turns. What did you see in the S&P and or market indicators that would have told you to exit or take some profits prior to 11/24/21 close? The crystal ball indicator would have been good, I guess. I love questions like that. What have we talked about on the show? I don't actually go back and listen to a lot of our old shows, although you are welcome to on our on-demand platform or on YouTube. You can go back to a particular date and see what we were talking about. I honestly don't do it too much because I'm always focused on the next show, and there's always seems to be things that we need to talk about next. However, things that we were looking at, I would say November, particularly in December, you had this challenge of higher highs in price, but lower peaks in a lot of momentum and lower peaks in a lot of breadth indicators. And for me, that's why I was turning a lot less constructive going into the end of last year. And it's a difficult thing to do when the markets are going higher, price is increasing, but seeing indications telling you that there's weakening under the hood. And this chart in particular, I remember looking at, and you can see some of these bearish divergences on the S&P using the RSI indicator, January, February of 2021, April, May of 2021, July, August of 2021. Now, all of those, I think, were valid bearish divergences. You had minimal pullbacks, 3 to 5% at most, and then the uptrend just continued. And so, Greg Morris, one of my mentors, has always said, all new highs are bullish except for the last one. And so I've found to always, increase my skepticism, increase my cynicism on market upside when I see market a move higher not confirmed by indicators under the hood. So I would be looking, if I were you, for what to look at next. Sort of the market top playbook for me has things like the RSI looking for bearish divergences, which I think we had, looking at leadership, so things like consumer discretionary versus consumer staples, talking about a lightening up. That really wasn't giving much of a signal yet until the beginning of this year when it really is rotated lower. and then finally breadth divergences. And that might be the most damning evidence I remember from that period. But I'd encourage you to go back and see what I was talking about. Maybe I had some really good ideas that played out well. Next question. I'm trying to discern the relationships between interest rates, the US dollar, precious metal prices, and emerging markets. That's a lot. It appears that a rising US dollar is a headwind for precious metal prices. Does the same general rule apply to the relationship between US dollar and emerging markets? It's actually a really good question. And I set up this chart just to illustrate the history. What's great about charts and technical analysis is you don't have to guess at a relationship. You can actually look at the relationship and look at, I was told one of my previous analysts, former analysts, used to call the charts the truth serum for the markets. There's a lot of discussion about what gold should do, or what the dollar should do, or what stocks should do given different environments. Charts actually tell you what's happening. That actually tells you what has happened. That defines the relationship. And so here I'm looking at the US dollar index on the top, the GLD, so gold second, and then EEM, emerging markets, bottom. So I'm using ETFs for two of these, but you get the idea. And if you look back over time, you can see, number one, a fairly consistent positive correlation between gold and emerging markets. So when gold is stronger, EM tends to be stronger. When gold is weaker, EM tends to be weaker. And if you go to the top series, you'll see that's sort of the inverse of the US dollar. Stronger dollar usually means weaker gold and weaker EM. Weaker dollar usually means stronger gold and stronger EM. So gold and EM tend to be pretty closely related. Same with like energy prices, kind of in a similar sort of bent. And all of those are inverse of the dollar. And that's why the stronger dollar in 2021 was not great for gold and certainly not good for EM. A weaker dollar environment, if that relationship holds up, would suggest that both of those are much more likely to turn higher. Those are really good questions. I struggle sometimes to answer some of those in a concise way, but I hope that was valuable. Keep your questions coming. We'll get to more of them later this week. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the S&P 500 bullish percent index. We didn't touch on breadth conditions in our market recap too much, if I remember right, but I think this is an important one. We talked about the bullish percent index, which looks at 500 point and figure charts. What percent of the S&P's point and figure charts, all the individual members, what percent of them are in a bullish signal versus a bearish signal? And just over 50%, once again, are in a bullish configuration. And it's actually pretty important, because if you look back at the last 8 times over the last 2 years, when you've had that situation where it's gone below 50% and then within a week or two gone back positive, that's actually been a pretty viable dip, a pretty consistent bounce in the markets. The problem, if you go back to 2009, I think there have been 3 or 4 times where it spent a lot more time below 50%. February, March of 2020 was one of those, but there are a couple other fairly significant pullbacks, drawdowns, like 2018, if I remember right, that had a similar configuration. So the fact that we've gone back above 50% is actually an encouraging sign for this market right now, but definitely a chart worth paying attention to. Number 2, I'm highlighting the chart of UPS. I'm actually listening to the podcast Business Wars on the ride into the office today, looking at UPS versus FedEx and how they started. As fascinating discussion about how those businesses evolve. But UPS certainly getting it done on an earnings basis today, leading the S&P higher, up 14%. What's interesting to me is it's gapping above resistance. And this sort of chart, one of the easier things to think about, because what this tells you is we've gapped higher. We've established that this stock is worth more than it has been in quite some time. And you have a really clear stop loss. 220 is that breakout level. As long as we hold that breakout point, 220, overall, the chart is pretty constructive. We would start to fail there. Then you need to be concerned about potential for further downside and a failed breakout. But at this point, breaking out of a base, a multi-month brace, certainly pretty encouraging. Final chart today on our 3 and 3 is Chevron CVX. When I was talking with Alex Cole today from GoNoGo Charts, we talked about a number of things. Talked about agriculture, you mentioned energy, and certainly when you look at year-to-date performance, it's sort of energy and everything else. I think financials are now probably positive for the year, but just barely. And it's really been energy dominating, up double-digit percentage-wise, while most sectors are flat to down. Worth noting the fact that you have a number of earnings this week on Exxon and ConocoPhillips and others, but overall these charts are holding up, ignoring the fact that the markets are in turmoil. Ladies and gentlemen, that is our show for today. Thanks so much for joining us. Special thank you to Alex Cole from GoNoGo Charts, joining us from New York and sharing his perspective. For StockCharts.com, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.